All right, welcome. Today we're diving into something really cool, a powerful concept that institutional traders, the smart money, use to spot major market moves. It's all about learning to see the market through their eyes, and it starts with finding their footprints.
So let me just ask you this. What if you could look at any chart and pinpoint the exact spot where a massive move is about to kick off, before it even happens? Well, that's exactly what we're going to explore. And believe it or not, it all boils down to spotting one single powerful clue on the chart.
And that clue, it's called an order block. So what is it? Put simply, it's the last candle of the opposite color right before a big, strong, impulsive move. You really got to think of it like a footprint in the sand. It's the literal mark left behind by that smart money, the exact spot where they decided to make their move and push the market.
Okay, so if these are footprints, then how in the world do we find them? This is the fun part, really. It's kind of like we're going on a hunt, and I'm going to show you exactly what you need to look for.
And you know what? This hunt is actually a pretty straightforward process. Let's take a bullish setup. That's when we expect the price to shoot up. There are just 3 simple steps to follow. First up, you need to see a clear downtrend. The market is making lower lows. Then, step 2, out of nowhere, you spot a really powerful impulsive move up, a huge green candle that just screams buyers are here. And finally, the most critical part, you find the very last bearish or red candle right before that massive upward explosion. And there it is, that little red candle, that's your bullish order block.
Awesome. So, you found the footprint. But look, spotting it is only half the battle, right? Now let's talk about how we can turn this little observation into a real actionable trading strategy.
Now here's the key. We don't just jump in blind. We have to be patient. We wait for the price to come back down and revisit that order block zone. Once it gets there, we're watching like a hawk for signs of confirmation. Clear signals that buyers are stepping back in. Maybe it's a long wick or a strong candle pushing away from the zone. When you see that confirmation, that's your trigger. That's when you enter the trade.
And of course, we're not trading without rules. Risk management is everything. Your stop loss, that goes just below the low of the order block candle itself. That's your safety net. And for your target, you should be looking for a minimum of a 1 to 2 risk to reward ratio. Honestly, the best setups are going to offer you 1 to 3 or even more.
So you're probably thinking, okay, this sounds pretty good, but why does it actually work? And that's a great question because this isn't random. There's a really powerful institutional logic driving this whole thing.
I mean, really, why does the price seem to have this memory? Why does it so often pull back to that one specific zone before taking off again? Well, the answer has everything to do with how the big players operate.
And here is the secret, right here. Institutions, the big banks and funds, they just don't enter their full position in a single candle. It's impossible. If they tried to buy billions of dollars worth of stock all at once, the price would skyrocket before they could finish. The volume is just way too big. So what do? They build their position in stages, right inside that little zone, our order block. They often have to let the price drift back down to that same area just so they can fill the rest of their orders at a decent price. And that is our golden opportunity. That revisit, that little trip back to the order block, is our chance to jump on board and ride the wave with them. Okay, but let's get real for a second. Not every opposite-colored candle is a valid order block. It's absolutely crucial to know how to separate the high-probability setups from the fakes that are just out there to trap you.
So here is probably the most important pro tip I can give you. A real order block is always followed by a truly explosive move, what traders call displacement. I mean, the move has to be so strong that it breaks past a previous high or low, what we call breaking market structure. A fake out? That's just a weak little candle with no real power or follow-through. If you don't see that massive displacement, just stay away. It's not the real deal.
So where can you start looking for these setups? Well, the source material points out a few places where this strategy works especially well. Think equity swing trading, or, for you intraday folks, on indexes like the NIFTY and BANKNIFTY. It even works well on things like silver ETFs. And as for timeframes, the sweet spot seems to be the 15-minute and the 1-hour charts.
And there you have it. You now know how to spot the footprint, how to build a whole strategy around it, and most importantly, why it works. You can literally see the trail that smart money leaves behind. So the only question left is, are you ready to follow it?